Hello, gentlemen, and welcome to another Palaview Market Research video. Today, we're going to be discussing how to evaluate and value. Literally, we're discussing the methods for valuing companies and assets, right? We're going to be covering mostly how you quantify and value a liquid, publicly traded asset. And we're going to be walking through a bunch of different case studies and examples, okay? But this is one of the more important videos, especially for like a market research related channel like this one. And if you're out there trading the markets and you're out there stock picking, then you want to have this base of knowledge in order to improve your ability to analyze their financials, what their chart is actually doing relative to their earnings, and through all these different perspectives. Okay, so we're gonna walk through a bunch of these, and we're gonna have case studies for all of them. So let's just get started. Okay, so our first one is owner earnings valuation. This is one of the more famous ones that Warren Buffett is famous for using. It basically adjusts net income, like a typical net income metric, to focus on long-term sustainable cash flow to the owners of a business. Because ultimately, what is a business for? A business exists so that the owners of the business receive money, right? And that's what Warren Buffett likes. Turtle overlord. He likes money, right? So to calculate owner earnings, it's net income plus depreciation plus amortization minus capital expenditures minus changes in working capital. This is more realistic than simply net income because it accounts for these capital expenditures and working changes in capital, okay? Now, when Warren Buffett first invested in Coca-Cola in 1988, he used this valuation methodology for evaluating and justifying this investment to shareholders, okay? Because at the time, Coca-Cola actually had a very high PE ratio. And what was interesting, but juxtaposed against that high PE ratio was a low capital expenditure that it needed to continue to invest to maintain its cash flows, right? So Warren Buffett understood that this was a powerful brand that wasn't really going to go anywhere. And if they didn't have these, intense maintenance costs that a lot of these other businesses have while keeping this cash flow moving, then it was going to be attractive long-term investment. Hence why he still owns it to this day. Revenue-based valuation. This is probably the one you're most familiar with, that you hear guys online talking about, like, oh, I sold my business for 3.5 times top line revenue, 5 times top line revenue, 6 times, right? And this is mostly applied to, your average tech companies, right? Because with a tech company, their growth is dependent on their network effects. So if you know that the user base of a product like Zoom is going to multiply 10 to 50 to 100x over a 5 to 10 year period, then you can apply different different types of, like I believe that in, earlier this year or late last year, a lot of these AI startups are raising at 20 or 30 times. Actually, I think it was like 26x was the peak average over a quarter period, where these AI startups were receiving investments from venture capital funds at a 26x top line revenue, right? Because say you have a product that's doing $100,000 a month and you can justify, like, hey, we're going to turn this into $1 billion business. And then with you, we can turn this into a $10 billion business, right? These are the narratives that you want to be familiar with, not just investing in the stock market, but also pitching investors if you have a business that you want to, throw some lighter fluid on and get some venture backed, okay? Now, discounted cash flow. This is one of the more interesting ones, especially in the context of Tesla. Now, this is when the valuation estimates the present value of future cash flow. So they're trying to price into the equity the value of future cash flows that they feel are guaranteed, right? So this famously happened with Adam Jonas and Morgan Stanley, when Jonas identified, like, hey, this is not a car company anymore. It is my job here at Morgan Stanley to research automobiles, but this is a technology company. We can't just view this as investment bankers, like this guy over here. Look at him. He looks like he knows what he's talking about. He understood that this was now a technology company, and that a lot of these massive capital expenditures that Tesla was making was going to pay off in the long term, and that this thing is massively undervalued because people are trying to look at their financials and say, oh, these financials make no sense if it's a car company, right? But if you put it into context, they're like, oh, well, these capital expenditures will lead to this increase in revenue, then it makes a lot of sense. And that's why in 2019, it was a lot thanks to Jonas and Morgan Stanley that Tesla just absolutely ripped. Now, a nice simple one. This is a very important one to understand. This is just fair value valuation. So you see this, equation at the top left here. Fair value equals cash flow divided by 1 plus discount rate, to the power of years, right? So this is an estimate of a company's true worth based on future earnings, assets, liabilities, and other factors. So this is famously Benjamin Graham and Geico, and then later Warren Buffett and Geico. Graham invested in Geico. It was very small. Geico was very, very small, and it was a rapidly growing insurance company. And he identified that it was very undervalued because it had these strong fundamentals and this growth potential. And it was very hard. I mean, especially back then in the context of, the 1940s, identifying a company that was going to be able to scale nationwide, you needed to just stick to much simpler principles than maybe we will be considering in our modern area here in the 21st century, where we have, businesses like Tesla, right? Okay, this is a cool one. Sum of the parts valuation. This is one of the ones where if you understand this and you identify opportunities and you're able to raise a lot of money, you can make huge amounts of money, okay? This is basically when you take a giant conglomerate and it trades at valuations and multiples that just make no sense relative to its assets, right? But maybe it makes sense relative to its individual, to the aggregate revenues that they create. So this famously happened with this guy Nelson Peltz, who's a very private, just badass guy. He's very close with Musk, as you can see, and he's got this famous family and all that. But he's like very private behind the scenes. Doesn't really matter. Basically, he bought into General Electric when it was just this conglomerate that was teeter-tottering and wasn't really performing all that well. But it had all of these different industries and companies within the company that were wildly more valuable, right? So they had an aviation business, they had a healthcare business, a power generation business, a renewable energy business, and an oil gas business, financial services, and transportation, right? So he was able to buy the company, basically treat each of those businesses as their own individual businesses, and spit them off and sell them at greater multiples as individual entities once he kind of came in and cleaned them up, right? This is a famous example of this. And yeah, if you want to learn about how to be a sick investor, definitely go learn about Nelson Peltz and read more about that acquisition, okay? This is very simple. Payback time valuation. This is basically like if I buy into an existing asset, right? Like a solar farm, right? And it's already cash flowing. And I know that, okay, if I invest $1 million in this and you're going to give me $250,000 a year in cash flow in exchange for that $1 million right now for 7 years, then I know in 4 years I'm going to have my principal back, right? So this is very simple, right? So it's kind of like an annuity, like that kind of feel. Net asset value valuation. This is also very simple, and it's comes back to just the fundamental valuation of assets, right? So Bruce Flatt and Brookfield Capital Management, asset management, I should say, they are one of the best in the world at doing this. They have a deep history of acquiring commercial real estate at below market prices, especially during downturns. This guy, Bruce Flatt, there's nobody in the world, in my opinion, who's better at dealing with bankrupt giant assets. Okay, this guy is an absolute fiend for that kind of thing. So basically what he would do, just as a simple example, he'd buy an office building that is just in a prime location in, say, Manhattan, right? And it's just tired and old and no one's given it any love anytime recently. He'll buy it. He'll use his connections to renovate the thing and make it look great. And then he'll use more of his connections to fill it with, 15, 20 or 30-year leases by these big companies, right? And then he can double or triple the asset's valuation like that, just because, they have the systems for doing these things quickly and efficiently. and then also the networks to fill these things up. Now, EBITDA multiple valuation. Bill Ackman's always talking about EBITDA. He used this when he went to, purchase Hilton back in the day, because Hilton was trading at a much lower EBITDA multiple than their peers, because they were focused on doing a lot less capital intensive investments. So like these other hotel developers and franchisees or whatever, they were actually building their own hotels, while Hilton was basically just leveraging their brand and allowing these other individual developers to take on the actual construction risk, the building risk, and Hilton would just get the $250,000, $170,000 annual franchise fee, allowing the building operators to just use their flag, right? This is very common. Franchise models in hotels is pretty brilliant if you can come up with a great brand, because it's basically like having a subscription based business where, like, hey, you give a building and the owners of that building a bunch of rules that they have to follow. They get to put their name on your name on their building, right? And in exchange, they basically pay you like $250,000 a year. And if you have, thousands of buildings that are like this that you didn't take the risk of building yourself, wow. And that's exactly what Hilton did, by the way, to grow into the giant conglomerate, whatever you want to call it, that is today. All right. Now, historical multiple valuations, this only really applies to really old companies like Coca-Cola, right? But if you see that, like, for the majority of Coca-Cola's history, they trade at like a 20x top line revenue, and now they're trading at 15. That's a little bit weird because PepsiCo's at 21 times. This could inform a choice. And I kind of, on a side note here, I often see these PE ratio multiple discrepancies to be really intense with large furniture and retail flooring businesses, because there are such few players in that space and brands matter a lot, especially with the flooring businesses. Like, there's only like two major players, Floors Decor and LL Flooring. It's very interesting. There's a huge discrepancy between those two companies, and though LL Flooring is a much less sophisticated business and it's a lot worse of a brand, but the top line revenues aren't too crazy different from Floors Decor. It's just fascinating because Wall Street just obviously puts such a premium on Floors Decor relative to LL. And I don't see those multiples moving. So I don't know, if you want to start a flooring business to compete with one of those two players, probably have a nice avenue. Now, liquidation value valuation. This is another one of my favorites. Wilbur Ross here shown, he famously bought Bethlehem Steel because Ross basically calculated that Bethlehem Steel had all these hard assets. And if it was liquidated, it could just provide a lot of cash, because there were a lot of things like it had these pension liabilities, and that was impacting the valuation of the equity, but it doesn't actually impact you as an owner per se. So essentially, he sold off a huge amount of these assets without really paying the pensions of these people. So that's a little bit questionable, but hey, we'll keep moving. Comparable company analysis. This is a really interesting one, learning about Dan Loeb and how he did this. So Loeb's team at Third Point, they compared Nestle to other multinational consumer goods companies like Unilever, Procter & Gamble, and Mondelez International. And these companies operated in similar industries. And as you can see up here, he basically determined that for whatever reason, they're just trading at a much smaller multiple, despite the fact that Nestle probably has a better moat than all these companies. So, well, maybe not Procter & Gamble, but definitely Unilever. So he made a great purchase and made a great trade on it. And this was how he did it, was just comparing it to competitors through, tracking price to earnings, price per share. Now, to wrap this up, guys, I know this is a little bit drier of a video, but it's important that we kind of go back to these important educational topics every once in a while, right? So valuation is not a one-size-fits-all process, because each company operates in its unique context, okay? So you want to always be, when you're trying to understand a company's valuation, you want to understand what context it sits in. If it's a young company, if it's a tech company, then you have to think about it fundamentally differently than Bethlehem Steel, the companies that are worth not worth, that are 100 years old, right? So you have to use different valuation methods that are tailored to capture different aspect of a company's value, depending on what industry it's in, what size it's in, its maturity, its stage of growth, and what market conditions it sits in, right? So if you have a company that's really good at selling, luxury pianos in California, right? But everyone's moving out of California, then maybe you don't want to be so focused on that, right? Okay, cool. Hope you guys have a great weekend. And yeah, we'll keep doing these. And if there's any topic like this that you guys want to see more of, put it in the comments and we'll try to get it done. All right. Thank you guys.